Excel tutorial, Treynor ratio performance metric. Portfolio performance metrics consist of portfolio expected or realized risk premium by unit of risk. This topic is part of investment portfolio analysis with Excel course. Feel free to take a look at course curriculum by clicking link at description box below. This tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please read full tutorial disclaimer at the end of this video. Treynor ratio consists of portfolio expected or realized risk premium by unit of systematic market risk. For full reference, I recommend that you read Jack Treynor, How to Rate Management Investment Funds, published by Harvard Business Review in 1965. As a formula, we have the ex-ante or expected portfolio returns Treynor ratio, which is equal to, and within the numerator, we have the expected risk premium as the difference between portfolio returns minus the risk-free rate of return, which is then divided by the portfolio's expected market beta. And then we have the ex-post or realized portfolio returns Treynor ratio, which is equal to, and within the numerator, we have the portfolio returns mean minus the risk-free rate of return mean, and that result is then divided by the portfolio market beta. The portfolio market beta in turn is equal to, and within the numerator we have the covariance between portfolio returns and the market returns, which is then divided by the variance of the market returns. Within this tutorial, we'll only be studying the ex-post or realized Treynor ratio. If the risk-free rate of return is not constant through time, then the portfolio returns Treynor ratio is equal to, and within the numerator, we have the portfolio returns mean minus the risk-free rate of return mean, and that result divided by the portfolio market beta. Because of having that risk-free rate of return being not constant through time, then the portfolio market beta is equal to, and within the numerator we have the covariance between the risk premium and the market risk premium. Risk premium as the difference between portfolio returns minus the risk-free rate of return, and the market risk premium as the difference between market returns minus the risk-free rate of return. That result is then divided by the variance of the market risk premium. Again, market risk premium as the difference between market returns minus risk-free rate of return. On the other hand, if the risk-free rate of return is constant through time, then the portfolio returns Treynor ratio is equal to, and within the numerator we have the portfolio returns mean minus that constant risk-free rate of return, and that result divided by the portfolio market beta. This portfolio market beta calculated using the same formula as in our previous slide. And last, if for simplicity purposes we assume a 0% risk-free rate, then the portfolio returns Treynor ratio is equal to, and within the numerator we have the portfolio returns mean, and that result is then divided by the portfolio market beta. Again, this portfolio market beta calculated using the same formula as in previous slide. Excellent. So let's go into the Excel file so that we can study Treynor ratio with greater detail. Perfect. So here we are within Treynor ratio performance metric Excel file. So we're going to begin this video tutorial by working within the orange colored Treynor ratio data worksheet. So as we can see here, we have 3 columns of data. Column A with dates, column B with SPY, and column C with MKT. So as we can see dates, those dates have a monthly frequency and they go from the beginning of 2007, so we select A6 and then we press Ctrl down arrow on the keyboard, they go all the way to the end of 2016, therefore 10 years of data. So we press Ctrl up arrow, down arrow to go into the beginning of the column. Then at column B we have SPY. SPY corresponds to the ETF investment vehicle which intends to replicate the Standard & Poor's 500 index. And here we have the monthly arithmetic returns of its adjusted close prices. Adjusted close prices which were adjusted for dividends and splits. So here we have SPY adjusted close prices, monthly arithmetic returns. And then we have MKT. MKT corresponds to the market portfolio, and here we have its monthly arithmetic returns. So now that we have the data ready, we're going to proceed to calculate Treynor ratio. So we go into the orange colored Treynor ratio calculation worksheet. So within it, as we can see, we are going to calculate the monthly Treynor ratio of SPY, monthly arithmetic returns, and we're going to do it assuming a 0% risk-free rate for simplicity purposes. For this, first of all, we're going to calculate for the numerator of that monthly Treynor ratio the average monthly return, as we see here at B7. So we select B7 here, and we see that it's equal to, and then we have average built-in Excel function of Treynor ratio data from B6 to B125. So just double checking, we go into Treynor ratio data, and we see that's the average from B6. That's the first of the monthly arithmetic returns of SPY. We select it, then we press Ctrl down arrow on the keyboard, goes all the way into B125, which is the last of those SPY monthly arithmetic returns. So again, we press Ctrl up arrow, down arrow to go into the beginning of the column. So back into Treynor ratio calculation worksheet, next we are going to calculate SPY risk premium market beta. As we're assuming a 0% risk-free rate, then it will be SPY monthly arithmetic returns market beta. So for this, we are going to select B8, and we see the calculation equals to the built-in Excel function of slope. And within it, first of all, we have Treynor ratio data, B6 to B125, which is the column with SPY monthly arithmetic returns, comma, Treynor ratio data, column C6 to C125, which are the market portfolio monthly arithmetic returns. So just double checking here, we go back into Treynor ratio data, and as mentioned previously, at column B, we have the SPY monthly arithmetic returns, and just double checking at column C, we have at C6, the first of this market portfolio monthly arithmetic returns, and if we press Ctrl down arrow, we go into the end of the column at C125, we have the last of those corresponding monthly arithmetic returns of the market portfolio. So we press Ctrl up arrow, down arrow to go into the beginning of the column. And back into Treynor ratio calculation worksheet, now that we have the average monthly return and then the corresponding market beta calculation ready, we can continue with the calculation of monthly Treynor ratio for those SPY monthly arithmetic returns, and assuming a 0% risk-free rate for simplicity purposes, which is what we do here at B9, and we see within the formula bar that it's equal to B7, which is the average monthly return, divided by B8, which is the risk premium market beta. As mentioned previously, in this case, for risk premium, it will be SPY monthly arithmetic returns because of that risk-free rate return equals to 0%. Perfect. So now that we've finished studying how to do the calculation of this monthly Treynor ratio for SPY monthly arithmetic returns, assuming a 0% risk-free rate, let's go back into the slides. And as mentioned previously, this tutorial has an educational and informational purpose and doesn't constitute any type of trading or investment advice. Please pause the video now so you can read the full tutorial disclaimer. Okay, so with this we finished this tutorial. Thank you for watching.